You could argue that the sell-off in equities was preceded by weakness in Treasuries. Lots of different concerns, fears of inflation, of course, an increase in supply, a weak dollar to boot. What is the narrative? It's changed, certainly, but what is it now?
You're right, it has changed a lot. I think there's a lot of things, as you mentioned. I think some of it is that the market's finally catching up with Fed expectations. I think the labor market's starting to take, hold with wages and employment. And I think that the market's waking up to the fact that the plan that the Fed put in place is actually probably justified. So I think they were a little bit behind the curve going into the year. And now I think we're probably at a point that's probably about right.
We've had a lot of false sell-offs for years in the Treasury market, or in, even since crisis. We get some of these mini tantrums or whatever. Is this one different?
I think it's a little different, but I wouldn't even call this a tantrum. I would say this is just normalizing. I think that yields are going probably where they should be. I think we're at a pace this year where the Fed will probably go at minimum 2 times, at most probably 4. I think just a week ago, we were at near 100% probability of a hike in March. We've dipped back down a little bit, but I still think that March is very likely. But then after that, there's probably still a few more to go. And if you look at the long end of the curve too, and we start to see the long end of the curve sell off a little bit too, and today 10-year real yields, less break-even expectations are at, recent highs.
What are the linkages between the sell-off in Treasuries and the recent sell-off in risk assets?
Good question. I think that for a long time, the market's been predicated on low volatility, low discount rates, and, the realization that I think the increase in rates is actually justified. And, risk assets are waking up, and, everything prices off of the risk-free rate. So whether it's investment-grade corporates, whether it's high yield, whether it's stocks, everything's tied together. And when the risk-free rate moves, other risk assets are going to have to adjust, and I think that's what we've seen.
How long does this adjustment take? I mean, it can be painful and it can shock a lot of people, and some people aren't even convinced of it, so they kind of hold out. But in general, what do we know about how long this process takes?
It's a good question. I think, I think there's still some normalization left. I think within some areas of risk assets, REITs, utilities, a lot of defensives, and they've really gotten hit on the chin. And I think to some degree, you can start looking at some of those asset classes to start getting into them, or getting some exposure. I think they're getting a little bit attractive, and these are assets that are tied to the 10-year that maybe have been overdone a little bit. What's interesting, credit really hasn't budged much at all.
Why?
I think there's a lot of reasons. One is the economic backdrop is pretty good. Earnings have come in well. The macro backdrop is very supportive. There's a lot, not much supply coming in the investment grade, world. So I think that, that's a lot of the drivers of that. The problem is there's a lot less cushion now. So investment grade corps, there's a meager spreads over Treasuries, and the same kind of goes for high yield. And you have to ask yourself, do you really have any cushion to be buying these now? There's not really credit risk per se. And I think when you look at this sell-off compared to, say, early 2016, credit has not moved here, whereas in early 2016 it really did, and it was dislocated.
But if it tends to lead, then you've got to be really sure there's a bigger problem here rather than perhaps just a temporary pullback, if indeed that's what this is, and ultimately we can continue to rally from here. But you sent out an interesting tweet on Feb 5th, and you said we should realise our understanding of markets is always far less than we believe it to be. Our ability to predict is an exercise in futility. I think that was quite a perfect statement to make on that particular day. But the president tweeted this morning, and I'm not tying the two things together, but he did make the point in a sense that we were in a situation now where good news for the economy perhaps may mean bad news for the markets. And we've been there before. We were talking about a fear of missing out problem, and now we're talking about perhaps good news being bad news. Can both those things hold true at the same time?
That's interesting. I think market participants that have been around a while, I think, would recognize that there's a big difference between the economy and the stock market. And you go back to early 2009, we didn't bottom on good news per se. So bad news was still going on. And I think we can have a healthy sell-off and really maybe even some more with the economy just doing fine.
David, something you've talked about in the past is this idea that when we get a sell-off, there are different aspects. So sometimes it's duration, sometimes it's liquidity, sometimes it's credit. Right now, it's all duration. Do these things, if they persist, tend to bleed into each other eventually?
I think they do. In the case of credit, as we were talking about, though, I think spreads have really absorbed a lot of the rate increase, but I think there gets to a certain point when people say, well, I can get the risk-free rate at this.
Right.
Do I really want to stretch myself and take, the credit and liquidity risk to go into there? So there's different inflection points, and I think that the fact that the underpinnings of the economy and corporate earnings have been so good, and the technicals of the bond market have also supported that, and has really not crept up. But I think there's a point at which it gets, there's a spillover, and people are not willing to take incremental risk for very low marginal return.